Hi guys, I normally don't do anything in relation to the budget. I normally focus on business and business as usual. However, there have been major changes that were announced last night. I'm going to give you my quick take and also where I think the winners and the losers are and a bit of forecasting as to where the opportunity might be. First, unpack the changes to negative gearing. First of all, existing properties that you already own and your current tax structure, they apply. Everything is grandfathered up until the budget announcement last night. Moving forward, any new property that you purchase, if you wish to negatively gear it and you own it in your personal name, you cannot do that. The only exclusion to that is brand new property. Doesn't apply to company structures, doesn't apply to properties owned within trust structures, but within your personal name, can't purchase and negatively gear moving forward after this date. Next change, major one, obviously, is the change to the capital gains tax discount. The 50% capital gains tax discount does no longer apply after 1 July 2027. Anything after that point, your capital gains tax will be indexed. There'll be a nominal rate of 30% that will apply to the capital gains on the indexed realised capital gains. Up until that date, the existing rules are grandfathered. Also, new properties are exempt from this particular ruling. Okay, so let's talk about the winners and losers in relation to the negative gearing changes. This was sold to us last night as something to help with intergenerational equity and fairness. Look, it's a load of crap. At the end of the day, rents are going to go up. Because the rules have been grandfathered, and whether you agree or disagree with the rules, because they've been grandfathered, no one is in that existing tax setting is going to sell. The minority who may sell will be sold to owner-occupiers, but the fact is 250,000 people are still coming to this country every single year. We are not building enough homes. That's only going to put continued upward pressure on rents. Also, if there's no new supply, how are you going to keep up? There's only one way that rents are going to continue to go up. So where you might see a bit of adjustment is the speculators who are holding housing with the view that houses might go up. You might see some of those sold off. That's probably in that $1.5 to $3 million price point, I would say, in most major cities. But at your affordable price point, where this budget was essentially meant to help, I don't think that's going to happen at all. I think you're going to see rents continue to go up. And I think yields will compress because of the long-term rental security that's going to be there. So your losers are your renters. Your losers are probably your speculators who've bought houses on low yields or plan to do that as part of their investment strategy. They're probably losers. Now, the interesting thing is the carve-out for new property. Now, the challenge is new properties anywhere in Australia, you can't get a new unit built for under $1 million. Once you factor into your land, your GST, a little bit of profit, $1 million is the absolute minimum entry point. $1 million is not an affordable price point for people to participate in. So, developers, if you're in the market now and you want to be a winner out of this, you have to be able to promote your capability, your safety, in terms of your ability to deliver a quality product that's going to be safe and is going to continue to appreciate, to attract the limited amount of investor interest that might stay there. So potentially your developers in your mid-markets are winners, but again, I think there's going to be more losers, and the losers are particularly going to be the ones that this budget was trying to help. Now, let's talk quickly about the CGT changes and the winners and losers. The losers is probably the boomers and those that are approaching retirement or well into their retirement years, who've worked hard to save and preserve an asset, particularly the pre-CGT 1985 assets. I think to avoid a tax fight and probably to realise those gains and probably the nature of the ownership and the age of people who own those type of properties, I'd say a lot of those will probably come to market and get sold. But again, they're not going to make a massive difference to housing supply because they're typically in blue chip areas, they're typically larger assets at a higher price point. So opportunity for maybe for some upsizes there, but I think the losers are typically the boomers that own those assets that are pre-CG. The big winners are likely to be developers who are developing build to rent, or people who treat investment property and development and rental housing as a business, because all of their tax provisions and CGT discounts still apply, and the structures which they typically own these assets in essentially are unprotected. So you can roll your losses in, you can claim your losses against your future gain, and again, all that's going to do is just incentivize, in my mind, institutional grade ownership of affordable residential housing into the future. So that means built to rent, co-living funds, and probably your investment bankers looking to create big syndicates and listed entities that trade and deal in residential real estate. That's where I think the future will go, which is very sad because this is the exact opposite, I think, of what these policies were paraded to us as the people they were meant to help. really, it's probably going to help the big end of town who can raise big amounts of equity, form specialised entities and special purpose vehicles to manage residential real estate.